Hello, everyone. I am Kim Hughes. This is another edition of Sane Crypto Live. I want to say Happy New Year's Day to you. If you are a replay listener, appreciate you dropping in. So happy whatever day it is for you, and I hope 2018 is treating you well so far. So today's topic is first principles of investing. This is really important and fundamental, so we're going to cover it in a little bit of depth. But first, let me just very briefly, mercifully briefly, for those of you who don't know me, tell you a little bit about me. Who is this person? Why should I listen to her? So this is not my first bubble, by the way, but it might be my first podcast or live. No, I'm kidding, but I forgot to pull my microphone over. So I'm a 20-plus year investment industry veteran and critic. I cut my teeth trading options as an off-floor trader on the Chicago Board Options Exchange many moons ago, when it was very much the wild, wild west, like cryptocurrency is today. I am an author, a speaker, and the inventor of an investment method, which I went on to turn into an award-winning investment firm, which I sold last year, retired here to South Carolina, to my polo farm, and intended to live happily ever after until I saw some of the crazy bad advice being given in cryptocurrency and hence sane crypto. So I have a question of the day for you, which is, are you currently invested in cryptocurrency? Yes or no? Just yes or no in the comments below. That would be most helpful to me in terms of knowing who I'm talking to and where you are at. And with that as preamble, we'll move on to the topic at hand, which is first principles of investing. So what does that mean? Well, a first principle is defined by Wikipedia as a basic, foundational, self-evident proposition or assumption that cannot be deduced from any other proposition or assumption. You hear this a lot in the world of startups and investing. And ours are, one, this time is never different. Never. Two, no one can predict the future direction of price. No one. Number three, trees don't grow to the sky. Number four, pigs get fat, hogs get slaughtered. And number five, fear and greed are your biggest enemy. And the way to control fear and greed is a SANE system repeated over and over again as if your life depended on it, because it does. And I would argue that if you don't have sound first principles, or at least borrow first principles from someone who's gotten the result you want over a long period of time under different and challenging conditions, then you are playing a game against some of the brightest minds in the world for money without any clue of the game that you are playing. I mean, if you just think about how absurd that is on the face of it, like if you went out to play a game of American football against the New England Patriots without knowing the rules, how successful do you think you would be? You would be eaten alive, okay? So first principles are your touchstones. They tell you what to do and how to think about any situation that might arise. That's their purpose, okay? Everything you do in terms of your investments should flow from those first principles. So let's quickly go through ours again, one at a time. So number one is that this time is never different. If I had $1 for every time someone told me, oh no, this time is different, over the years, yeah, that proverbial thing, I'd be rich. So Ray Dalio, who is the founder of Bridgewater Associates, the largest hedge fund in the world, In fact, they manage more than the total market cap of cryptocurrency. So, kind of a big deal. He puts this principle this way. He says, and this is from a quote from a podcast he was interviewed with Tim Ferriss. He said, everything is another one of those. So that's how he put it. And then he said, in other words, almost everything happens over and over again through history, and that the key to success is to identify what one of those it is and to look at how it's worked in the past many times, and then to understand cause and effect relationships and develop one's principles for dealing with it. Now, of course, the obvious comparison to make here, as much as cryptocurrency believers and diehards hate it, is to look that this will look like the internet bubble of the late 1990s. In fact, it will roughly approximate every technology bubble, okay? Which, by the way, does not mean that you should roll your eyes at it or run away screaming with your hair on fire. Quite the contrary. History tells us that this has a high likelihood of being an investable bubble with a lopsided upside-downside skew. And those don't come along very often, okay? However, the flip side of that is every day that passes is one day closer to that bubble bursting. Right? I'm not saying we don't know whether that is tomorrow or 10 years from now, right? That is yet to be seen. However, the fact is every day is one day closer to the bubble bursting. So, if you are sitting on the sidelines trying to decide whether or not to get in, every day can be potentially expensive. Now, so on to our second prediction. Sorry, not prediction. It's about predictions. It's our second principle, is that no one can predict future direction of price. No one. Okay? And this is the hardest one for investors to wrap their brain around because, number one, Wall Street spends $56 billion a year because they are based on the illusion that they can. Right? So they spend $56 billion a year to promote that illusion. When in fact it's like, Wizard of Oz, there's a small little man back, anyway, don't get me off on that. But number two is the other reason is that markets have the same addictive qualities as gambling or heroin, right? What causes, if you think about it, if you study addiction theory, which I have, what causes addiction is random, variable, intermittent reinforcement. So the fact that technical analysis or stock picking or anything else only works often enough to make you think it is reliable, but not often enough to actually make you money, that logic is fogged and clouded. You can't see it because of the big dopamine hit that lights you up every time that slot machine lights up, right? Or ting, ting, ting. You thought that something was going to happen and it did, right? Or you made money. So, Finance 101, any first level finance student knows that markets are random, okay? The only argument among academics, who, by the way, have no financial incentive to promote either market timing or stock picking, or now crypto picking, right? Altcoin picking, is the only thing they argue about is not the randomness, but which mathematical formula describes that randomness. And I could literally talk to you about this for hours and hours and show you reams and reams of data to prove the point. But we'll have to save that for another day. But make no mistake, Wall Street, okay, and markets, including crypto markets, are largely driven by dopamine, not reliable patterns. You might as well try and predict the pattern of grains of sand falling through an hourglass, which when you understand and you really know that, right, it makes market commentary, whether it's on CNBC or, some podcast about what the crypto markets are doing, it's even that much more farcical when you understand this. It's so easy to get sucked into, though, because our brains are pattern matching machines on dopamine. All right, here's number 3. Trees don't grow to the sky. Markets are closed systems. Closed systems are governed by the laws of ecology, believe it or not. Our body's a closed system, right? The earth is a closed system. Markets are closed system. And the fundamental law of ecology says that in a closed system, nothing can exist in a state of extreme indefinitely. In other words, closed systems and therefore markets are cyclical. They go up, they go down. That's what it means. And so the corollary to this is that on the flip side of that, markets can remain irrational a lot longer than you can remain liquid. So never, ever, ever bet against the cycle. Always go with it. So when you combine this with number 2, that prices are random and can't be predicted, along with this idea that markets are cyclical, what this tells you is that, and by the way, this is common sense, hence when you think about it, but hence first principles, right? What this tells you is that you must construct your portfolios in such a way that you are okay whether price goes up or down, which leads perfectly into number 4. Pigs get fat, hogs get slaughtered. All markets have an expected rate of return over time that they will happily give you. And if you are patient and just take that return without getting greedy, then the market will happily give it to you. It's not that hard, actually. But if you take more than your share, you get greedy, the market has an almost magical mechanism that hunts you down and takes everything. I mean, anyone in the markets has seen this at work, right? So we, again, going back to this one and the one before, we construct a portfolio that maybe takes a little bit less over the short run in exchange for protection against the cyclical downturn, in this case, in this particular market cycle, from us protecting us from the investable bubble to ashes, okay, before the caterpillars and butterfly phase. So, which professional investors understand this, right? But amateurs and newbies don't. And their brains are just taken over with the dopamine, okay? But guess what happens? Markets are zero-sum games. I only make money by taking it from someone else. And that's true across the market. So guess who the pigs get their money from? Hogs. That's the way it works. Okay? Which takes us to number 5, which is the most important point. You must understand this truth if you ever hope to be a successful investor in anything other than a raging bull market where any idiot can make money. Okay? The ability to make money in this market does not make you a genius. Anyway. All right. So number 5 is that fear and greed are your biggest enemy. And without mechanisms to control them, they will cause you to do the exact wrong thing at the exact wrong time, which is to buy high and sell low. There's a study called Dalbar, done by a research firm called Dalbar. It's the quantitative analysis of investor behavior. It's been done for well over 20 years now, and it consistently shows that the average investor earns below average returns year in, year out. So as an example, for the 20 years ending in 2016, the S&P 500 averaged 9.85% a year over the last 20 years. That's that kind of expected return that I was telling you about. It's got ups in it, downs in it, but a pig, right, can be expected, should be expected to make that 9.85% return. And yet, right, and that's not bad, right? And yet the average equity investor only earned 5.19% return. Okay? That's over 20 years. For the 12 months ending December 30th, 2016, the S&P 500 produced an annual return of 11.96%, slightly above the expected market return, and but the average stock investor only earned 7.26%. Okay, in both cases, and over time, a gap of almost 50% between what the market did and what the average investor earns. Okay? This was true 20 plus years ago when I first started as an off-floor options trader. It was true in 2001 when I started my investment firm. It is true today. Now, why is this? It's because investor behavior, that's you, the investor, right, and me, right? Whether you were talking about stocks or digital assets, the actions we take are illogical because they are based on emotion. They are based on fear and greed. And so what you take from this, okay, and the way that I've been able to make money for myself and for clients over a really long period of time is by understanding and implementing this one concept. The way to control fear and greed is a sane system repeated over and over again as if your life depended on it. Because while your physical life may not, your financial life does. So, watching your portfolio every day, which I see people doing, in all of these Facebook groups and forums and Reddits, asking people, why did this go up? Why did this go down? Right? Trading in and out of stocks or crypto or altcoins, trying to buy the dips. Okay. These are little dopamine highs that are causing you to, in the words of the character in Ernest Hemingway's Sun Also Rises, go broke gradually, then go broke suddenly. So that's it for my 5 investment first principles. If you found this helpful, I do these Facebook Lives now every day, every weekday, Monday through Friday. It's sometime in the late morning, usually East Coast time in the United States. If you would like a notification of when I go live via a Facebook Messenger, just go to sanecrypto.com. The URL is down in the bottom left corner there, sanecrypto.com/live, which will take you to our Facebook Messenger, and then just type in the word live and our bot will take care of that and send you notifications. Also, if you did find it helpful, leaving that in the comments below, along with any questions that you have that I can answer, thoughts, comments, etc. It would help a lot if you would do that, as it tells Facebook that I am publishing valuable content and that should be seen by more people. So I would really, really, really appreciate that. Plus, I love answering questions and chatting with people, so feel free. You can learn more about the SANE Crypto system at sanecrypto.com. Again, down here in the bottom. Let me see. Hang on. I'm trying to get my disclaimer text to display. There we go. Because I can't remember it off the top of my head. So remember that disclaimer, here it is, that everything that I might have said is for educational purposes only. Nothing should be considered investment advice. Past performance has no guarantee of future results, and all investments involve risk, especially this one. Could go to zero tomorrow, so do not, under any circumstances, invest money you cannot afford to lose. All right. Thanks for listening. I will be back tomorrow with another installment of Sane Crypto Live. Until then, remember, you guys, pigs get fat, hogs get slaughtered. I'm Kim Hughes. Now go forth and conquer.